Welcome to the J&J Show. Today we got a special guest, Keith Skinner from Newberger. He's a vice president and portfolio specialist covering the international and the emerging markets. Welcome, Keith.
Thank you for having me.
Yeah. So, you got something, Josh? You want to start?
No, only a case of appreciate you joining us. So, needless to say, you have a position in the portfolio that you're associated with. So, that's why we try to have these discussions of what we're thinking and why. Just by virtue of a couple quick administrative things. So, I'm sorry we do not have your picture on the wall. We'll do that better in the future. But as we were talking about previously, we do finally have a sign up. We're experimenting with some different layouts for the podcast between video and sound and everything else.
I was thinking with AI, we had a discussion about AI in our last podcast. Maybe we can use AI and get you inside.
Assuming you want to be on it.
Yeah.
I'd appreciate that.
Or,
My mother always said I had a better face for radio, but
I know the
we say the same thing about Josh.
Yes, that's true.
He's got the voice.
But no, appreciate you coming. So, what are we talking about today? International.
Yep.
So not U.S., not domestic. As many people probably know, we increased our international exposure over the past couple of years, really. But I think, as you were indicating, part of the elephant in the room historically has been, if you had a large exposure to international, say, since 2020, you may not have been as excited about it. My words, not yours. So it's probably a reasonable place to start of looking at it as a whole.
Yeah, kind of what I want to know. International had a good year, right? Seems to have cooled off a little bit, but what's the outlook going forward? Is it something we want to stick with long term? And if we do, kind of, what areas of the international markets do we want to look at?
yeah. So I mean, to start, I've covered international markets for the last 30 odd years. And actually, if you go back in history, there's been some quite substantial periods where international and emerging markets have outperformed for long periods. If you've started your career or started investing in the last 15 years, it hasn't been such a good experience. A lot of that was to do with how international markets approached the recovery from the financial crisis. The US dealt with things much quicker. So the recovery was really delayed. There was problems in the European banking sector, for example. European government debt loads were very high. Then we had Brexit in 2016. COVID was particularly punishing on a lot of countries like China and emerging markets. But we do think that things started to change around 2022. We've been through this long period of low growth, low inflation, low interest rates, low investment, a period of relative peace, to one now where a lot of those things have really turned on their head. And if you look at the underlying construct of international markets, they could be in a good position going forward to benefit from a lot of these trends. If there's a capex super cycle, not just related to AI data centers in the US, but Germany have announced this big fiscal spending plan. China is spending, Japan is spending. So it would be, we think, moving forward, the real economy type sectors that could benefit more, which they haven't done in the last 15 years, but moving forward, we think they could.
How do you, or to what extent, and it's a loaded question, but I'm of course going to ask anyway. So needless to say, there's any number of headlines, at least at the time of shooting, we're talking about the Middle East still, and where not just current events in the Middle East, just as one area, but also discussions around expanded military spending in Baltic countries or in Europe. How all of, and what other themes I may be missing, which I'm sure there's plenty, tie into the thought process of where we should be looking, where you feel has more opportunity than others, and what that opportunity may look like.
Yeah, so I'll just say there's been underinvestment in a lot of parts of the world, in a lot of different industries over the last several years. Let's use Germany as a case in point. So post-financial crisis, I think the Germans really wanted to prove a point to the Southern Europeans about budget discipline. And so they committed to not spending much money. And while that worked for their debt to GDP ratio, it hasn't really worked for their economy. They've had some bad luck along the way or some poor strategic decisions. They got most of their gas from Russia, which has now been turned off. So electricity prices are very high in Germany for businesses and consumers. They've also, they're big export markets. China's been struggling. US is a big export market. Mr. Trump, as we know, is throwing more sand in the gears of global trade. And Germany's really underinvested in its military. So after the election in Germany last year, it came really clear that Germany needed to do something new. And so they committed to this huge fiscal spending plan, which equates to about 20% of GDP in relation to defense, infrastructure, energy security, or you could call it really strategic autonomy. You don't want to rely on anyone else anymore. And they really don't have a choice anymore. So this is really happening. It's a huge investment, and that will lead to lots of opportunities, not just in Germany, but across Europe, because Europe is such an interconnected continent that there will be lots of spillover effects of that fiscal spending. But even in Japan, the new prime minister there, Takaichi, she's often called the Margaret Thatcher of Japan. She's very pro-business, pro-reform, is looking to do more fiscal spending. We're seeing rates move off the bottom in Japan, which they've been zero forever for the last 40 years. You're seeing inflation, rates going up. That's creating opportunities in the banks. So it's not just defense. Defense is a big part of it, but there's spending in all sorts of areas that can create big opportunities from the bottom up stock picking level.
Yeah. Speaking of defense, obviously Josh had mentioned the war in Iran, right? Now, when we think about that, obviously oil prices and how they've been affected, how much of a headwind do you think that's going to be for the international markets, again, versus here domestically? And are there certain areas or certain countries it's going to have more of an effect on than others?
Yeah, I mean, it's a great question, very topical. We have a huge advantage here in the US that we're sort of energy independent. There are countries that are much more exposed to it. I mean, at the moment, it's some of the smaller markets in the ASEAN region, Southeast Asia, where they would be heavily reliant on energy exports through the Strait of Hormuz. Some of these countries, like the Philippines, for example, have reduced to a 4-day working week. Government employees have been encouraged to work from home, so they're not using transport. I would say Europe is exposed to the higher gas prices. They have done a pretty good job since 2022, when the Russian gas supplies were turned off, of diversifying their supplies. So they get more now from, actually, if you look at LNG exports from the US to Europe, they're breaking records every year. They've signed more contracts with North African countries, for example. The challenge for Europe is that they still get, call it, low double-digit percentage of their energy supplies from the Strait of Hormuz, and it's the marginal supply that sets the price. So even though they have a lot more renewables than they used to, a lot more LNG than they used to, they're still competing on the global market with Asian buyers who, in some cases, are quite desperate. So it is impactful. Obviously, we're hoping for some kind of resolution and a swift resolution, but that's something that we're watching really closely.
Could you tie, kind of Venezuela into that and kind of the events there? And is there any opportunity around that you see? Or
I mean, from a market perspective, there's not really much we could invest in Venezuela. Obviously, it's still very early days after the changes that happened earlier this year. Look, I think it could be an opportunity, but you saw when Mr. Trump invited the heads of the US energy majors into the Oval Office, they weren't all jumping across the table to invest there, because apparently the infrastructure is still really, really dilapidated. There's a lot of capex required. And I think when the war started and oil prices went up to $100, they're more willing. But I think there's a long way to go there.
That's kind of where I was leading you with. We've had some people ask about it. And I think hearing that from an expert,
Well, not all oil is the same.
Yeah.
You learn that through this. There's heavy, there's sweet, there's a big difference in the refining process, the amount of money it would take to, say, for example, refine oil in Venezuela for US use, etc.
Exactly. I would say energy is one of those areas as well. There's been a lot of underinvestment in new supplies as well. I know we're energy rich here. The Permian Basin, etc., is producing a lot of energy. But given what's happened in the Middle East, and maybe more so on the services side, where a lot of these companies have had their operations impacted, they've had to downgrade numbers for this year. But moving forward, you've got to think that a lot of these countries are going to look to try and get away from being reliant upon the Strait of Hormuz. Right, the Saudis built the East-West pipeline many years ago. That's been actually relieved some of the pressure from the Strait of Hormuz, but a lot of these other countries are going to be looking to build pipelines, etc. So for some of the oil services companies, including the ones in Europe, there could be a big opportunity moving forward.
Yeah. So thematic, then we have some individual country areas of the world. We have Japan, we've spoken about. We talked about Venezuela, not in respect to investment. We talked about Europe. Where are the areas that you or you guys see that don't fall under kind of the big name categories enough for a period of time? Brazil used to be on people's list. I don't know if it still is. I don't know as far as the Australian economy goes. Are there sweet spots that are underappreciated in your opinion that have opportunities because they're smaller or just don't have the same news coverage, etc.?
Yeah, I mean, I would say Japan, even though we touched on it briefly, Japan's a really interesting case because it's still quite a big part of our benchmarks. It's probably sort of 23% of our benchmark. We have been underweight Japan I've been at the firm for 15 years, all of those 15 years, and way before that, significantly underweight. But some of these changes that are happening, not only rates moving off the bottom, which is creating an opportunity for the financials in particular, but in terms of the reform measures that are coming down from the government plus the Tokyo Stock Exchange, who have recently implemented these new listing rules, whereby if Japanese companies don't meet these requirements, they're threatened with delisting. Not all exciting stuff to talk about necessarily, but fundamental reform happening in these companies that is leading to higher returns on capital, better treatment of shareholders, and Japan is a big market, so there's huge opportunities there, we think.
Yeah, one thing I want to kind of hear a little bit about too. Obviously, the markets here have really been driven by tech and AI and so forth. When we're looking at more of the international markets and the emerging markets, do you feel there's that same potential growth there? With tech and AI, or is it a whole different story?
Are there other headwinds
Yeah.
or tailwinds that we're missing?
I mean, it's a really interesting question at the moment because what's happening in the emerging markets specifically, emerging markets had a very good year last year after a very difficult decade or more. This year is having another very good year, but if you think the US market is highly concentrated, emerging markets this year are about as concentrated as a market could possibly be, and it's really focused on a couple of large stocks in the benchmark: Taiwan Semiconductor, Samsung Electronics, and SK Hynix, all chip companies.
Yeah.
Are absolutely dominating the returns in those markets. So while you might look at emerging markets and think, wow, these returns are really attractive,
Yeah.
looking under the hood, it is very narrowly driven.
Yeah.
So you do have to be a little bit careful with just looking at the returns and thinking this is, you can keep this going. I would say that there's parts of the supply chain, the semiconductor supply chain or the AI supply chain, which again, Japan has a big opportunity there. Parts of Europe, some of the big beneficiaries of the capex spending that you're seeing coming out of these hyperscalers will be European companies or Japanese companies. So there are pockets of opportunity.
Do you see any opportunity, obviously, where the returns have been focused, with a few companies in the emerging markets, for those markets to broaden?
Yeah, I mean, in Korea, you've got not dissimilar to Japan. You've got there's been a governance issue historically, where a lot of these companies are tightly interconnected with the government or each other, and you've got this reform push by the government to try and improve corporate governance, which is creating opportunities outside of just the big chip companies. And so I think, look, as we've said at the beginning, there's been a huge amount of underperformance from international and emerging markets relative to the US. A lot of these countries are looking at the US, and the leadership is changing in these countries. Maybe some of them have even been educated here. Maybe they've seen how capitalism works and how corporate governance can be better, how shareholder returns can be better. And even in Europe, the old saying was within the sort of technology sector was that China brings the hardware, the US brings the software, and Europe brings the regulations. And European companies have historically been overburdened with regulations, and it makes it very difficult for them to compete on a global basis. But even the European policymakers are starting to wake up to that. There is a new commission set up to try and lessen the burden on these European companies. So I think everyone is looking at the US and thinking, how can we do things better?
I mean, and that would strike me as the best opportunity right now is kind of unknown based upon that. Then so if you have multiple countries changing regulation, from what I don't want to misspeak, but it sounds like it's a case of tech is the rising tide that is raising all ships across the board, which may or may not go on forever. And it sounds like some of these areas may not have, based on the concentration, they have 5 or 6 companies that are really moving the whole region.
Yeah.
So is that a concern that if there's looking at just even the market in the past few days, a grand rotation out of tech, it seems like that may actually be across the board regardless of where your house is.
Well, specific, yeah, I mean, good point. Specific to certain markets. I mean, some of the Asian markets I already mentioned would be heavily exposed. I think if you looked at Europe and Japan, yes, they have some of the supply chain exposure, but in terms of the percentage in those benchmarks, it is a very low percentage. Our primary benchmark for our international strategy is MSCI EFA.
Yep.
There's only about 8.5% in information tech in that benchmark relative to the US. I don't even know where the numbers are today. It's moving around by the day based on the volatility, but it's a big number. So I would say that and even the concentration levels, if you look at Europe and Japan, I think the biggest stock in our benchmark is less than 3%. Right, so the opportunity is much broader, we think, in those markets. And again, when it comes to a lot of the fiscal spending that's happening in Germany, for example, it's not just tech related, it's related to energy security, and they don't have a choice. So they really have to push through. So it's infrastructure, energy infrastructure, energy security, and upgrading the grid, building out the grid more. And even in the US, where you're seeing this massive data center spending, and you're seeing all these agreements between the hyperscalers and the utility companies to bring more power, because we don't want a baseload power problem here in the US, there's a lot of international companies that are benefiting from that. Right? There's transformer companies in Japan and Europe. There are gas turbine companies in Europe that are benefiting just as much as the GE Vernovas are in the US. So I would just say it's a massive opportunity set. And a lot of these changes that have transpired in the last 5 or 6 years, whether it's we now have wars, supply chains are shortening rather than lengthening, we're bringing stuff closer to home. Nominal growth will be higher, rates are higher, inflation's higher. If you look in history at when international has outperformed, 70s, the 80s, the 2000s, there's a lot more consistent in this current environment than the last 15 years, where we had low growth, low inflation, low rates, and investors were prepared to pay a premium for growth. And so the US tech companies that were growing got a premium valuation, but now a lot of those business models are changing, right? The hyperscalers are taking on a lot more debt, still net cash, but there'll be a point in the probably not too distant future where some of them go into a net debtor situation. Maybe the market doesn't reward them with such a high multiple. Then they'll start to look for opportunities in the rest of the world. And I know we did speak pre-podcast about the size of the market caps of some of these US companies, but we're talking of trillions of dollars in market caps in single companies, which are bigger than the entire markets of some of these countries that we're talking about. So if you had even a tiny portion of selling in US tech, pretty much wherever that goes is going to have a meaningful impact.
And if this is not a question for you, that's fair, right? But I've had a few clients, or more than a few, ask about the strength of the dollar, and can you talk a little bit about that and how that ties into international markets and opportunity there as well?
Yeah, well, look, I mean, part of the reason international has underperformed post-financial crisis is due to the strength of the dollar, right? Your clients are dollar-based investors. If you have assets overseas and you're converting a weaker euro asset or weaker sterling asset or weaker yen asset into a stronger dollar, it's been a big headwind. Part of the reason international outperformed last year was the dollar finally started to weaken. Now, it has been on a bit of a trend. If you go back to 2022, I think when the Biden administration weaponized the dollar against Russia, quite rightly so, I think we could probably agree, that led other foreign central banks to start to look at their reserves and say, well, what if something happened to us? Do we really want all of our reserves in US Treasuries, which they tend to hold? And so you've seen them start to diversify away from, not completely, and I wouldn't panic about the dollar not being the world's reserve currency, right? I mean, I'm from the UK, as you can tell by my accent. The UK lost.
Just noticed it.
Yeah. The UK lost its status as the world's largest manufacturer in the late 1800s, lost its status as the world's largest economy in the early 1900s. Sterling didn't lose its status as the world's reserve currency until after the Second World War, so it went on for 50 years. But at the margin, if countries are diversifying away from the dollar, that leads to dollar weakness. Last year, dollar had its worst year since 1973. that added 10% for internet. 10% of the 30-odd% return was from the weaker dollar. And what's really interesting, if you look at the Russia-Ukraine war, euro dollar around that time was about 117. The war happened. It went to about 1 in quite a short space of time. Since Israeli and US jets flew into Tehran, the euro dollar has gone from about 117 to 115. So you haven't seen nearly the same strength in the dollar that you would normally see in uncertain environments. And that, to us, suggests that the path of least resistance for the dollar may well be continuing down, which for your clients investing overseas, that would be a tailwind rather than a headwind.
Right.
I don't know about thematically if I had anything on that.
Yeah.
Now, of course, I guess it's somewhat thematic, but also headline. Space, the final frontier is, okay, SpaceX is not yet publicly trading at the time we're talking about this, but it's somewhat the, dare I say, the meme stock era still takes place time and time again. We have a little bit of it going on right now with space. One such example, I doubt it's US dominant if we're talking about Rocket Lab, for example. So are there very niche-y, or are we seeing the same thing overseas where, okay, space is what people are talking about right now? I don't know if that's going to be a tailwind, headwind, what it's going to turn into. Is that the methodology? Is it just US investors that fall into these specific themes, or is that, using space as an example, something internationally that comes up?
No, I mean, again, you don't tend to have the giant market cap companies. It tends to be much nichier businesses. Actually, interestingly, with space, they tend to be, a lot of the defense companies do, some defense, some space, some aerospace.
Defense,
And so we have found some opportunities in businesses in Europe in particular that maybe do the rocket launchers and different things like that. So yeah, I think that's kind of a broadening theme, and quite often because the US company is the headline name and the massive company that gets all the headlines, but there could be a valuation opportunity in those types of companies much smaller in other markets because they're just less well known. And so that is something that we have found opportunities in for sure.
Perfect. Speaking of large markets, right? We talk a little bit about China. What's going on there? How that may affect us? Their growth and
Well, we have clients afraid of China is the word I'll use. Not
exactly.
Of, are the numbers real?
Yeah.
Is it government subsidization of business? Well, I don't have the 100% clear or known answer to that. We don't have a lot of China exposure, but it's also just not an area we play in a lot of what's real and what isn't. That's the comment we probably hear the most.
But it's something that we do hear about and clients ask about. So if you give us a little bit of your thoughts around China.
Yeah, I think so. First of all, its significance in the emerging markets has shrunk because it was 40% of the benchmark at one point. It's now down to 25 or less, which is not good. It's good that you don't have as much concentration, but it's not good for China because it means they're not doing as well. But there are, there's still some great companies in China. I mean, we tend to do it on a stock-by-stock basis rather than listening to official government figures. Their GDP number will be whatever they want it to be, right? You could look
manufactured number.
You could look at other things like electricity consumption to try and get guide, and that would be very different. But I think China has a lot of structural challenges. Youth unemployment is really high. You don't hear from the Chinese media because they're not allowed to tell you. You hear sort of stories that there's more social unrest. The real estate sector is still a big problem in China. That's had knock-on in second and third derivative impacts on growth, on consumer sentiment. So, we still invest there on a case-by-case basis, but more broadly, China has a lot of challenges, and they're not going to be easy to come through it. So it's not an area where we have a huge amount of our portfolios. But it is still an important part of the international emerging markets.
Well, I think when you look at it from a client perspective, right, they think that, oh my goodness, China, they're just taking over everything, and they're going to become the world leader in the world economy and the world currency, and based on what you're saying, that's really just not the case.
Well, we thought the same about Japan in the 80s, right? And Japan was about I believe it's about 70% of the MSCI EFA benchmark in the late 80s. And if you want a plug for active management, just when you didn't want 70% of your international exposure in Japan, you would have had it if you bought the benchmark. So benchmarks are inherently backward looking. And as I said, China was 40% and now it's much less. So, I think looking at things on a stock by stock basis, obviously in some emerging markets, the top down is quite powerful. And you have to take into account the government, the central bank, the strength of institutions, the currency, is it free floating? Have they historically had inflation problems? Is the central bank independent? You look at a lot of those factors because they could be so meaningful, like in Venezuela, for example, that if you found the best company in the world, it might not be a good investment because the country is a basket case. So we do look at that stuff as well.
Perfect. I know we covered a lot here, and
the only other one that I see more specific ETFs, for example, coming out. There's two oddballs I've seen. Well, not oddballs, but two I've seen recently that I didn't previously. Norway, which had not necessarily been on my list, and then India always seems to float in and out. Sometimes I hear about explosive growth, sometimes I don't. So I guess just two specific areas, again, much like China. Thoughts, yays, nays, real numbers, fake numbers.
Yeah, I actually haven't seen the Norway one. I'm guessing when oil goes over $100 for quite an energy dependent country, that kind of thing tends to happen. And sorry, what was the second one? India. Yeah. So look, India is. I think the mistake people make with India is that they look at the size of the population and they say this is the next China. India is still a long way behind China in terms of its development. If you look at income per capita, GDP per capita, is still much lower. I mean, there's hundreds and hundreds of millions of people still in the rural areas, and it's still very underdeveloped. I think the government there have done a good job of, under Narendra Modi, of trying to, improve infrastructure and do some other stuff, reforms that have helped. The perennial challenge with India for stock pickers like ourselves is that because so many people think it's going to be the next China, and the GDP growth is still 8% or so it's massive.
Yeah.
The problem is it's always the most expensive market in the world. Actually, may have just been overtaken by Taiwan. But Indian stocks are never ever cheap, and it's been very expensive. So India had a good run for the last 18 months. It's been a big underperformer, partly because it was just too expensive to begin with. So yeah, there's still a theme there, but always be careful when there's a lot of performance.
That's like there's some hype in it. So some hype built into the pricing then.
Exactly.
To kind of bring it all together, we've talked a lot about different macro, kind of micro, different countries. When we think about the international markets as a whole, do we want to add exposure? And again, you're going to be biased probably, right?
Yeah.
Add exposure, hold, or decrease exposure. And then after that, as far as looking at individual countries, a country to add exposure to and a country we maybe want to avoid.
Yeah, I would say the Iran war, before the Iran war, we would have been more bullish because you could see the fiscal spending was really only approved late last year in Germany. It takes a while for that to come through. It's going to happen over several years, and but because of so you started to see some of the data. The PMIs were getting much better. Was starting to come through. Then the war started. Gas prices went up a lot, and you've seen consumer sentiment dip. You've seen inflation go up. The ECB could potentially hike rates at their next meeting this month, and so there's a little bit more concern around Europe at the moment. So whether or not I'd be adding right now, I'd be watching what happens. Okay. But if you were going to say to me, if the question was, do you think diversification will work better over the next 5 or 10 years than it did over the prior 5 or 10 years, I would say yes, for sure. It's just how long is it going to take to get through this short-term issue. In terms of markets that we really like, again, we do things on a stock-by-stock basis, but given a lot of this fiscal reform is happening in Germany, we are pretty bullish on a lot of German companies, and there's a great industrial base there. There's some phenomenal companies that really well managed, have been out of favour for a long time because there's just been very low capex. Now we're moving into a period of high capex, and these companies should be beneficiaries of that. But Japan, as I mentioned earlier, we're still marginally underweight. But we've had a lot of the team go on research trips there, meet a ton of companies. There is real change happening there, and so Japan's interesting to us. In terms of markets we would avoid, I mean, China, because a lot of the structural challenges, that is still a concern for us. And we would just be careful around those markets that are dominated by a couple of companies that have had phenomenal returns. So look, some of these companies are phenomenal companies, but there is
The level they're at now.
the level they're at now. We would just be careful about sort of piling into these markets after such good returns in the rearview mirror.
Perfect. Well, I think that's, I mean, we pretty much covered everything.
Yeah,
Keith, I want
yeah.
to thank you for your time and your insights. They
Very
were,
much so.
yeah, they were great. With that, that makes, this is a wrap on episode 13 of the J&J Show. So like,
Comment.
subscribe, and we'll see you guys next time.